For decades, it has stood as one of the most recognizable symbols of American culture, finance, and soft power. From Main Street diners to global skylines, the Golden Arches carry weight far beyond the menu board. That's why a stumble at McDonald's doesn't just read as a line item on a quarterly report. It ripples through retirement funds, grocery bills, and the confidence of everyday families. In 2024, Reuters reported that McDonald's global comparable sales fell by 1% in the second quarter. It was the company's first decline in over 3 years, and Wall Street reacted quickly. By July 2024, McDonald's stock had dropped roughly 15% year to date. For an investor in their 60s, relying on dividends or pension funds tied to these shares, that decline wasn't abstract. It meant a thinner cushion for medical bills, housing, or helping a grandchild through college. McDonald's has always been woven into the daily fabric of American life. A dollar menu burger in the 1990s was an easy choice for a working family. But today, that same quick meal feels more like a luxury when the broader economy keeps tightening. The story of McDonald's is not only about earnings calls or Wall Street forecasts, it's about Main Street, where retirees, small-town farmers, and fixed-income households feel the pinch first. When a giant like McDonald's falters, it signals something deeper, that even America's most affordable comforts are slipping away. Nowhere is this more visible than in the rising cost of simply eating outside the home. According to the U.S. Bureau of Labor Statistics, the price of food away from home was up 3.9% year over year in August 2025. For seniors living on the Social Security or modest pensions, that percentage point increase translates into skipped meals out, tighter budgets, and tougher choices. At the same time, McDonald's announced in May 2025 that it would shut down its COSMC's experiment, an ambitious beverage concept, after only 18 months. It was a quiet but telling retreat, a reminder that even America's biggest brands are vulnerable in today's climate. And that sets the stage for the real question. If fast food itself is no longer cheap, what does that mean for Main Street America? On May 23, 2025, McDonald's quietly confirmed a decision that spoke louder than any ad campaign. The company announced that its experimental beverage chain, known as COSMC's, would be shut down. By June 23rd, the mobile app tied to COSMC's stopped functioning, marking the official end of a project that had lasted only 18 months. It was supposed to be McDonald's answer to Starbucks: colorful drinks, youthful branding, and new revenue streams. Instead, it became a reminder of how quickly consumer demand can shift when household budgets tighten. The shutdown landed just weeks before McDonald's reported its second quarter earnings. On August 6, 2025, the company told investors that global comparable sales rose 3.8%. Revenue was up 5%, and system-wide sales jumped by 8%. On paper, those numbers looked encouraging, but executives also warned that costs were eating away at the gains. Higher prices for beef, potatoes, and packaging materials pushed margins lower. Logistics expenses, already stressed by trade disputes and tariffs, added more weight. Even in the U.S. market, where McDonald's launched heavy promotions and value deals, comparable sales rose only 2.5%. That figure was positive, but weaker than analysts expected. For customers, the difference was felt at the counter. Discounted meals drew traffic, but the underlying trend was clear. Families were spending more cautiously. McDonald's leadership framed the results as a balancing act, holding on to growth while bracing for higher costs. Yet investors watching the stock ticker saw something else: a company caught between inflation at home and geopolitical risks abroad. From the closure of COSMC to the mixed second quarter results, the message was consistent. McDonald's was still standing, but cracks were starting to show. And those cracks weren't just financial. They pointed to deeper strains across Main Street and the broader U.S. economy. McDonald's entered the summer of 2025 with numbers that looked strong at first glance. Global comparable sales were up 3.8% in the second quarter, and consolidated revenue climbed 5% year over year. System-wide sales, which include both company-operated and franchise restaurants, rose by 8%. Those figures reassured investors who had worried after a rare global sales decline in 2024. But beneath the surface, costs were eroding the gains. The price of beef and potatoes, the backbone of McDonald's menu, remained elevated. Reuters noted that commodity costs and higher freight rates continued to squeeze margins. Logistics disruptions linked to ongoing trade disputes and tariff battles added another layer of uncertainty. The U.S. market, typically McDonald's anchor of stability, showed only 2.5% comparable sales growth. That was positive, but short of analyst expectations. Executives admitted the growth relied heavily on promotions, limited-time offers, and nostalgia-driven campaigns. Those tactics worked in the short term, but they also cut into profitability. Meanwhile, stock performance told a different story. After sliding roughly 15% during 2024, shares had recovered some ground but remained volatile. Pension funds and small investors depending on steady dividends felt the impact directly. For a retiree holding McDonald's stock in a 401k or IRA, each dip translated into questions about whether their savings could cover healthcare or housing costs. At the corporate level, leadership struck a cautious tone. They emphasized value for customers while signaling continued pressure from input costs. The board stopped short of issuing bold guidance, instead warning that U.S. growth could remain muted if inflation persisted. That careful language was meant to calm Wall Street, but on Main Street it raised alarms. If America's largest fast food company needed to lean so heavily on discounts just to keep customers coming in, what did that say about the broader economy? Corporate data painted a picture of resilience, but also fragility. Margins were thinner, consumer demand was more cautious, and the outlook carried more caveats than confidence. In short, McDonald's was keeping the lights on, but at a cost that showed how much pressure American businesses now face under rising prices and trade headwinds. For most Americans, the impact of McDonald's troubles is felt not in boardrooms, but at the counter. The U.S. Bureau of Labor Statistics reported that the cost of food away from home rose 3.9% year over year in August 2025. Full-service restaurants climbed even higher at 4.6%, while limited service meals, including fast food, were up 3.2%. That might look small on paper, but for a retiree living on Social Security, it translates into fewer meals out each month. A family in Ohio recently told local media that their Friday night McDonald's tradition now costs almost $10 more than it did 2 years ago. For grandparents taking grandkids out after school, the bill stings in a way it didn't before. McDonald's has tried to cushion the blow. Value meals, nostalgia-driven promotions, and limited-time discounts were rolled out heavily through the spring and summer of 2025. They helped drive some foot traffic, but they didn't change the underlying math. Families still had to cut back. One retiree in Florida described it this way: "Fast food was always the cheap option. Now I think twice before I go." That hesitation shows up in the numbers. Reuters noted that U.S. comparable sales in the second quarter of 2025 rose just 2.5%, weaker than analysts expected. It means more people are choosing to eat at home, often cooking simple meals to stretch the grocery budget. And when McDonald's feels the squeeze, so do the suppliers. Farmers who grow potatoes in Idaho or ranchers who raise cattle in Nebraska depend on steady contracts with the chain. If demand slows, those contracts can be scaled back, putting local economies at risk. For everyday consumers, the reality is clear. A quick meal under the Golden Arches no longer offers the same financial relief it once did. Instead, it has become another line item in a growing list of costs that keep pressing American households. When Main Street begins to think of fast food as a luxury, the message is unmistakable. The economy is changing, and not in a way that makes life easier. What's next? In the best-case scenario, value meals and nostalgic promotions keep customers coming through the doors. Families still tighten budgets, but affordable bundles give McDonald's enough cushion to maintain steady traffic. Comparable sales remain positive, and suppliers from beef ranchers to potato farmers hold on to their contracts. It would not be a return to the booming growth of the past decade, but it would mean stability, something households on fixed incomes desperately need. In the mid-case scenario, inflation in the restaurant sector lingers. The Bureau of Labor Statistics already showed food away from home costs up 3.9% year over year in August 2025. If that trend continues, even aggressive discounts may not fully offset consumer caution. McDonald's would keep the lights on, but growth would flatten. Rural communities tied to agricultural supply chains would feel the pinch as volume orders slow down. Retirees and working families would continue to see fast food as a treat rather than a staple, reshaping how Main Street relates to one of America's most familiar brands. The worst-case scenario brings trade disputes into the picture. If tariffs escalate or foreign markets like China and India restrict access, the consequences extend far beyond U.S. borders. Tens of billions in potential market capitalization could be wiped out. American farmers who rely on export demand through McDonald's contracts could lose critical revenue streams. Communities already struggling with higher grocery bills and rising rents would face another layer of instability. And at that point, McDonald's would not just be fighting for market share, it would be a symbol of how economic shocks abroad can translate into pain at home. From best to worst, the scenarios differ in scale, but share one truth. Even the golden arches are no longer immune from the pressures shaping today's economy. When you step back and connect the dots, the story is clear. McDonald's is more than a restaurant chain. It is a reflection of how Main Street America absorbs economic pressure. One decline in global comparable sales, just 1% in 2024, was enough to shake investor confidence. By mid-2024, shares had fallen about 15% year-to-date, cutting into the retirement accounts of millions. Even after a rebound in 2025, growth relied heavily on discounts, nostalgia campaigns, and value bundles. That tells us something important. Stability no longer comes naturally, even for America's biggest brands. For everyday households, the reality is harder still. The Bureau of Labor Statistics reported food away-from-home costs up 3.9% year-over-year in August 2025. That single figure translates into skipped meals, tighter budgets, and families choosing home cooking over Friday night takeout. And behind every receipt, there's a ripple. Farmers in Idaho and Nebraska worry about contract volumes. Small-town communities tied to McDonald's supply chain brace for uncertainty. A pensioner watching a 401k fluctuate wonders how to cover medical bills or housing in retirement. This is the domino effect at work. A stumble on Wall Street becomes a squeeze at the counter, which becomes anxiety at the kitchen table. And when Main Street feels that squeeze, trust begins to erode, not just in one company, but in the broader economy. That is why McDonald's matters far beyond the golden arches. It is not simply about burgers or fries. It is about whether America's comfort foods can remain affordable symbols of stability, or whether they have become another warning sign that the ground beneath Main Street is less secure than it used to be. So where does that leave us? For decades, fast food promised quick, affordable comfort. But in 2025, even that promise feels harder to keep. We've seen how McDonald's, once a symbol of value, now struggles under the weight of higher costs, shifting demand, and global trade tensions. And we've seen how those pressures trickle down, from Wall Street portfolios to Main Street grocery bills, from farmers' contracts to retirees' Friday night meals. It raises a simple but important question. Is fast food still the budget-friendly choice for American families? Or has it become another reminder of how fragile the economy really is? That's where you come in. If you've noticed your own spending habits change, or if you've felt the pinch in your community, we'd like to hear from you. Drop a comment below and share what it looks like where you live. Do you still see McDonald's as a cheap option, or has it shifted into the treat category for your household? Your stories matter because they paint the real picture behind the headlines. And if you found this breakdown useful, consider subscribing and turning on the bell. That way, you won't miss our next deep dive into how tariffs, trade, and corporate decisions shape everyday life in America. Thanks for watching, and take care until next time.